financial freedom, and 10x returns. That's what every investor dreams of, right? Today we're talking about Opendoor, a potential multi-bagger stock that could rise well over 10 times by 2030. This real estate disruptor is transforming the way we buy and sell homes with its innovative iBuying model. And with the current challenging real estate market, risk-seeking investors have an opportunity to consider adding this promising company to their portfolio for just a fraction of the price it was just a few weeks ago. So let's delve right into why we believe Opendoor is one of the best real estate stocks to buy now and how it's set to revolutionize the future of real estate. Let's start by understanding the real estate industry's massive potential. With annual home sales in the US reaching an astonishing $1.6 trillion and less than 1% online penetration, there's a vast untapped market out there waiting to be disrupted. That's right. In the era of the internet, where everything from groceries to cars is sold online, the real estate industry lags behind with its offline, cumbersome and outdated processes. But that's all about to change. Opendoor, a leader in iBuying, has brought the entire home buying and selling process online, making it a breeze for consumers. Think about it. The traditional home selling process can be a real headache. It's often complex, uncertain, and time-consuming. Homeowners typically have to go through a long, drawn-out process of listing their homes, negotiating with buyers, and waiting for the right offer. The entire process can take months and is full of uncertainty and stress. Enter Opendoor, which has revolutionized the process, simplifying it into just a few easy steps. Homeowners can now go online, request and accept an offer, pick their preferred closing date, sign the papers, and close the deal, all within days. And the best part? It eliminates up to 100 days of hassle and uncertainty. Now that's a game changer. And for the buyers, Opendoor offers an equally innovative solution. Simply download the app, tour homes on demand, get financing at competitive rates, and even make an offer, all from the convenience of your mobile device. The current shift from offline to online consumption is accelerating rapidly. The rise of remote work has led to many people moving out of densely populated areas, searching for more space and a better quality of life. This is where Opendoor shines, capitalizing on these trends and serving a generation of consumers who demand a digital-first approach. By transforming the real estate process, Opendoor is positioning itself to capture a sizable share of the massive $1.6 trillion residential real estate market. Yet its market cap currently hovers at a mere $2 billion. Let us reiterate that Opendoor stock volatility is not for the faint-hearted, especially given the current challenging state of the real estate market. As interest rates have risen, there is a decreased number of homes being sold because most people are locked into 30-year mortgage rates at much lower interest than where market rates are now. This means that selling a home and buying another would involve financing at a higher rate, leading to increased monthly payments. This is one of the reasons why many potential sellers are staying on the sidelines. For example, consider a home financed with a 30-year mortgage with a balance of $400,000 and an interest rate of 3%. The monthly payment would be approximately $1,686. If the interest rate rises to 7%, the monthly payment would jump to roughly $2,661, almost $1,000 more each month. And while some experts predict a housing market crash, others believe it has already bottomed. Suppose the Fed initiates rate cuts early in Q2 of 2024, as its latest dot plot suggests. In that case, we expect the housing market activity to pick up and Opendoor to benefit remarkably from the rising number of people listing their homes for sale. Today could therefore be an opportune time for long-term, risk-seeking investors to capitalize on peak pessimism in the real estate industry and pick up Opendoor shares at what we believe is a hefty discount. Opendoor stock has experienced a significant decline in value despite its promising business model. The stock plummeted nearly 90% since its all-time high in February of 2021. However, there have been some recent signs of a turnaround for the stock. Between November of 2022 and May of 2023, the stock underwent a consolidation phase characterized by relatively stable prices and reduced volatility. Following this 6-month period, the stock has finally shown signs of breaking free from its prolonged bearish trend. Year-to-date, the stock has made an impressive recovery, surging by nearly 200%. Despite this rebound, it has been a challenging ride for the stock. It reached a high of $5.27 in early August, only to retract by almost 40% from this peak. We believe this price dip could present an attractive buying opportunity for high-risk seeking investors looking to capitalize on the stock's potential resurgence. With its stock currently trading at around $3.20, its market cap is about $2 billion. In comparison, its equity sits at just over $1 billion. And we believe that a book-to-value ratio of 2 times is very cheap for a company with the potential to grow immensely from current levels. But before you jump in with your eyes closed, it is essential to note that the company has been struggling in this challenging environment. Revenues for Q2 came in at $2 billion, down 53% compared to the second quarter of 2022, and down 37% from the first quarter of 2023. The company's revenue decline can be attributed to the slowdown in the housing market, primarily influenced by higher mortgage rates which have slowed down the market considerably. Opendoor sold a total of 5,383 homes during the quarter, which represents a decrease of 49% compared to 2022 and a reduction of 35% from the first quarter of 2023. As for the number of homes purchased, it was down by 81% to 2,680, and Opendoor expects to purchase roughly 3,000 homes a quarter through the end of the year. The company also provided very weak guidance for the third quarter, with revenues expected between $950 million to $1 billion, representing a reduction of about 66% from the same period last year. It was also much weaker than the $1.36 billion that analysts expected. It also forecasts an adjusted EBITDA loss between $60 million to $70 million, which, on the bright side, represents an improvement over the loss reported in Q2. But when having a closer look at the numbers, we can see encouraging signs of potential turnaround. Let's break it down. First, a significant portion of the second quarter's resale mix, precisely 57%, came from their old book of inventory, leading to negative contribution profit and margins. But here's where it gets interesting. Opendoor anticipates this resale mix to pivot primarily toward their newer inventory by the third quarter, propelling them back into positive contribution margin territory. Their new inventory book is performing very well, churning out gross margins of 14.4% and contribution margins of an impressive 10.6%. Now that's some solid groundwork for optimism. Thanks to the healthier blend of inventory and the company's improved holding periods, Opendoor anticipates achieving its target contribution margin of 5% to 7% by the close of 2023. It also expects to return to adjusted profitability once annual revenues reach $10 billion. We also like the cost-cutting measures the company has implemented previously to preserve liquidity during these challenging times. Closing out Q2, Opendoor boasted $1.6 billion in unrestricted cash and marketable securities and had about $10.1 billion of available borrowing capacity. This means they have quick access to large pool of funds, providing flexibility in operations and strategy. In conclusion, Opendoor's prospects are closely tied to the real estate market, which has been facing headwinds due to higher interest rates, low inventory, and decreased affordability. However, if Opendoor can survive this challenging real estate environment, and we think they will, this could be a prime opportunity for long-term investors with a risk-seeking profile to pick up shares at a steep discount by capitalizing on the market's current pessimism. We believe that the company stands to benefit significantly from a resurgence in the housing market and the departure of competitors like Zillow and Redfin from the home flipping industry. With cost-cutting measures in place and a focus on strengthening its offerings, the company could be well-positioned for market leadership and long-term profitability once the real estate market recovers. We believe that this stock has the potential to rise well over 10 times by 2030. What are your thoughts on Opendoor's potential? Do you see it dominating the home flipping industry in the near future? Drop your opinions in the comments below. Remember, the information presented in this video is for educational purposes only and should not be considered as financial advice. Always do your own research and consult with a financial professional before making any investment decisions. If you found this video helpful and want to stay up to date on the best stock opportunities, make sure to hit that like button, subscribe to our channel, and turn on notifications so you don't miss any of our future content. Thank you for watching, and we'll see you in the next video.